This is TreppWire with a special podcast. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Henry, Head of CRE and Advisory Services. And today we're talking with Tony Yousif, Director of National Accounts at SVN. Tony, welcome.
Thank you.
Tell the audience a little bit about your background and your experience.
Yeah, so I'm with SVN, formerly Sperry Van Ness. We have about 200 offices nationwide, and I've been with the company since 2008. Great timing. I came in and recession was about to happen, but at the time I was doing some San Diego-based multifamily deals and just thought it was overbrokered, too much competition. And so I had to try to find something that was a little unique and different. That allowed me to go after what I thought was going to be the next part of our industry and the cycle, reading about the RTC and SNL. I thought that the banks were going to be holding a lot of real estate with some of the bad loans that were made by Wachovia and, Chase, and at the time it was Washington Mutual and Lehman Brothers, et cetera. So got in with a lot of the banks, a lot of the institutions, got to learn about receiverships. And at the time, I thought it was Jerry Rice, but found out that they're fiduciaries for the court. We did what we could to just provide service and support to these institutions by helping them with valuations, due diligence, boots on the ground perspectives, and essentially becoming a single point of contact and strategic partner for all these folks all across the country. My role is kind of the conductor of the orchestra. I'm not on any marketing brochure or any of that stuff that gets out there, kind of the Wizard of Oz behind the scenes, and utilize the teams on the ground, whether it's Durham, North Carolina, New York, to help execute a plan and strategy that our lender clients accept after brainstorming and understanding what they want to do with the real estate that they've taken back or appointed a receiver on.
We're really eager to get into your thoughts on where the market is, where it's going, and what you've seen. But before we get into that, give us a little more detail about what SVN does and how you operate, perhaps for a particular bank and for a particular engagement. What is the process by which you support these institutions?
We provide investment sales, leasing, the normal brokerage, and of course, property management all across the country for commercial real estate, multifamily. And there's a lot of our clients. I'll give you an example. During the last downturn, Colony Capital was a huge client of mine that acquired a lot of notes from the FDIC, just like Oaktree did, just like Lone Star, Hudson Advisors. And they would contact us, letting us know that there was a loan in default. We needed to provide valuation services, help them understand what expectations can be in terms of the real estate value. And not only are we just doing the traditional putting it on a listing or the normal LoopNets and CoStars, et cetera, we're also looking at this as a pro forma. Can we redevelop? Can we reposition the asset? There were assets in Florida which were land that were unentitled, unencumbered by any real estate. And we were able to convince them at the time to allow us to hire the right consultants to take this through a site plan. It would be a 2-year process, but we would create value from, $7 million all the way to $30 million. And essentially we provided, we became an arm for a lot of these lenders that were based in San Francisco, New York, Dallas, wherever, in all these particular tertiary submarkets, these secondary markets. And we were able to give them a boots on the ground perspective from individuals that were there for 20, 30 years that really knew all the subsections of those cities. So we would be able to understand from the planning and development side and positioning from leasing and what's going on in that submarket, what can you and can you not do with this asset? And that's where there would be a lot of brainstorming where we would give the clients a 3-prong approach. You could sell it as is and not put much money into the asset. You could spend a year and spend, let's say, $1 million and try to get $2 for every dollar that you invested. Or we can do something completely different in terms of repositioning the asset, turning a small or a large vacant box into, let's say, self-storage. we look at ourselves as trusted advisors, partners with these lenders, and they continue to come back to us, luckily for us, after 15 years working with them. And it's been a great relationship.
Well, I know that our audience is going to really want to hear, especially since you have such a broad perspective across 200 markets.
Obviously, everyone's looking for distress, and your business is geared toward distress, right? Taking over the assets for the servicers, banks, and doing some of the work that you talked about. Walk us through some of the property types and what you're seeing right now.
Yeah. So, I've been trying for the last year or so to try to find some equilibrium or common denominator between the assets, whether it's geography or asset types. And honestly, I feel like every asset class is vulnerable with what's going on out there and what we're seeing. Now, the majority of the assets that we have been taking over are office and retail right now, but we've been seeing issues with assisted living, senior housing. There are issues that it's hard for the operators to cure: the labor costs, labor issues. You can't get nursing staff to stay, or you're not able to get the patrons to come back because there's still fear from COVID or whatever other disease is out there. So we're starting to see a few cracks in the multifamily system. We're starting to see and hear from even traditional owners of thousands of units say, okay, we've got to get these assets off the books. And I feel like we're getting anywhere from 50 to 100 valuation requests per month right now, asking us to help them kind of scrub and understand what the asset value is so they can decide whether they foreclose, put in a receiver, dispose of the asset, hold on to it. I mean, there's a lot of very high level conversation going on with our clients.
Yeah, Tony, so that gives us some pretty good perspective on the property types. Are you seeing any trends based on geography? I mean, are certain markets performing better, or maybe holding on a little bit longer? Or are you seeing some where, it's kind of universal that without regard to geography, so those properties are still struggling?
Yeah. So, I mean, New York's been hit pretty hard, but it takes quite some time to get through the courts with a lot of the moratoriums and issues there. We're hearing about defaulted assets that we just don't believe that we're going to be seeing for at least another 2 years, right? You got to just get through the system. But, New York, New Jersey's having its issues. We're seeing assets come back in North Carolina, South Carolina, Georgia. We just sold 3 office buildings in Jacksonville, which you would think, oh, Florida is, so strong. And honestly, they took them back, and within 6 months, we were able to sell all 3 office buildings with unsolicited offers. So there was still quite a bit of demand. We're seeing a lot in Texas, Houston, especially. Now, California, here in my backyard, here in San Diego, we're seeing some issues. We're seeing some in LA. And then, of course, I know you guys been touching upon San Francisco. We're seeing a lot of issues in San Francisco. We're managing an asset right now, over the last year. It's been very difficult to evict tenants that are not paying. It's been very difficult to get any assistance from the courts or government help to reposition the asset. And then we've been out to the market on that asset twice, and we weren't able to get anywhere near what the expectation of the bondholder wanted. And now they're stuck with this. And now they're saying, okay, should we put more money into it? And we're trying to convince them not to, because we just believe San Francisco doesn't have a bright future, at least in that subsection for that type of asset.
So let's stick with the multifamily for a second, because, statistically, that's been a really strong performer with low delinquency rates, high valuations, sizable rent growth year over year. But there's certainly headwinds, right? We've seen peak valuations, so there may be buyer's remorse down the line. A lot of this stuff was done in a repositioning mode where there's a business execution that has to take place. And a lot of it was floating rate, which is now not as inexpensive, certainly, as it was a year ago. And it may be challenging. Does multifamily that meets that criteria, right? The transitional floating rate thing, by and large, does that muddle through, or is there a bigger problem brewing in your mind?
Yeah, so I've been talking to folks at the different shops, whether it's originators to the Fannie Freddies of the world, and people feel like a storm is brewing. with the traditional ARMs and some of the loans that were made just recently. It's something we've been talking about for the past 4 or 5 years. Is you expect rent growth to be 5% year over year. You're buying it at a 2.8 cap, and you're getting a loan that's in place at, maybe 2%, 2.5%, 3%, whatever it is. But now you've got loans in the 6% territory. I mean, it's simple math. And I feel like rent growth is halted. I think it's going to come back down. I am no economist by any means, but I feel like things are a little delayed right now compared to what you're seeing in terms of inflation and all those other metrics that we look at. I don't think multifamily is going to crash anytime soon. I think it's going to be a slow burn, but we're hearing more and more, and we're getting more and more requests for potentially defaulted multifamily in terms of valuations and BPOs. So it's something that maybe over the last year or two, we were seeing very little of it. Right now, I'd err on maybe 20 to 30 valuation requests per month for multifamily. And it's all over the board. It doesn't matter what location. I mean, we were looking at, as an example, an asset in Bed-Stuy, New York, and we gave a valuation, and you have 90% occupancy with 60% of the occupants paying rent. Well, that's a huge issue, right? And then you've got rent caps and all the stuff that goes behind all the apartments over in New York. And we provided the valuation to the client, and they were just shell-shocked and said, look, we have an appraisal that is millions of dollars above yours. Well, okay, share your appraisal with us. And they did. They gave us about 48 hours to review. And it doesn't happen all the time, but we were able to explain to them that comps from Brooklyn or other areas, it just doesn't, it's not apples and apples. And we were able to convince them that appraisal was worth the paper that it was on. So now they go back and they're trying to realign their expectations and say, okay, if we were to take this asset back, it might look a little worse than what we expected.
Now, I want to let Martha go through the rest of the property types, but I do have one more question on the multifamily. And that is, a year ago, our salvation was going to be liquidity. There was so much money out there that was going to support any kind of bumps in the road, right? So many people had so much money raised to deploy that liquidity was just enormous. What does that look like now? Is the bidding pool as deep as it was a year ago for multifamily? Are you starting to see people say, we're going to wait for a better entry point? What's it like right now in that market?
So that's what causes me the confusion. I'm a logical person and I like to look at the data and everything, but logic has just kind of frustrated me over the last year or 2 years, because I feel like here's rent growth that is kind of tapering off and you feel like interest rates are going to have an impact. But then we go out and take a property like a multifamily deal, whether it's a tertiary, secondary, or primary market, and we put it on auction as recent as 4 weeks ago, and we get more than what we expected. And remember, the price point of that asset was sub $5 million. So that's an all cash deal. Somebody didn't need a loan, and there was tons of demand and competition for something like that. Now, 4 weeks ago, I guess, was a whole different world than it is today. I feel this is a week by week economy, but that's where it's kind of the antithesis of what I've been saying, is that there is still so much liquidity out there. And, I was in New York, Dallas, and other places in the past 2 weeks, just kind of doing a world tour, talking to different funds and different bondholders, et cetera. I feel like everyone out there has a distressed fund, right? Has all this flush cash waiting to snatch a lot of the assets that are out there. And multifamily is still, like industrial, at the top of the list. That's one of the main differences between the last recession and this one. So much liquidity and demand, and people are, quote unquote, prepared for the shoe to drop.
Yeah, that was going to be my follow-up, is the dislocation between, in the example you gave, you have maybe a rent roll that shows 90% physical occupancy on an asset, but 60% economic, occupancy in terms of tenants paying. There should be a corresponding dislocation to price, but when there's so much liquidity, sometimes that skews the fundamentals. And I think that's the part where it'll be very interesting to see as these assets come online, are people going to be willing to pay more than what, logic would say they should just because they have liquidity? Or are you going to see, people holding out for things to really bottom out and try to get the bargain basement deal? So I guess, as Manis mentioned, Martha has a couple of other questions, but just quickly, in your experience, what is the typical timing for this? You said that you got a lot more evaluation requests that are coming in. You're starting to see some activity pick up on that side, but just kind of maybe walk us through how does that translate into, something going from evaluation request to you actually putting it on the market to you actually transacting? What does that time frame look like?
I wish there was a consistency there. There's right now a lot of the assets. I mean, just in the last week, we've taken over 8 assets, and what I mean by that is our property management company that's national has physically taken over either a foreclosed or an asset that a receiver has hired us on, and that's just in this last week. And we're talking about there's multifamily, there's mixed use, there's retail, there's office, and every single one of those is in a different state. But all those assets were assets that were having issues over the last 2 years. And even some were even prior to COVID. None of them are new, right? So we've been tracking these assets through Trepp reports and everything for quite some time. And, it's the first time I've seen it where 2 of these assets, which are fairly stabilized retail assets, earlier this year, they got reinstated by their borrowers. And we found out 6 months later that 2 months after they got reinstated, the borrower went back into default. And, 6 months ago, our servicer client essentially told us, okay, don't track this anymore. This thing is healthy again. It's going away from special servicing back to the healthy side. So we're getting calls where, like I said, just in the last week, it was assets that we thought for sure were off from our tracking, and they will call us or email us, okay, gear up. You guys are going to need to take this thing over next week. So typically, I'd say of our valuations, if we're doing 100 valuations, maybe 5 or 4 actually turn into assignments. It's just part of the process. We have to provide this valuation and due diligence and support for our clients so they can constantly kind of understand and have a feel for what that asset looks like, whether it's pro forma or as is or worst case scenario.
So you're talking to a lot of lenders, different types, obviously. Take us behind the scenes, and without revealing any identities, what is going on in terms of what they're talking about, what they're concerned about, maybe stuff that we're not hearing in the press and in the media?
Yeah, so on my first day over the last 2 weeks, I was in the Midwest, and a big life company essentially told me, which was kind of a shocking thing that I've never heard, is assets that are essentially invulnerable to cycle changes, that assets in Park Avenue or, in New York or the cream of the crop in Dallas or Los Angeles, San Francisco, they're starting to worry about cracks on those assets, and they're starting to scrub those assets in their portfolio. And what I mean is okay, it might be time for us to reappraise or get broker opinion evaluations and understand, if we've got an office deal on Park Avenue that's only 40% occupied, and most folks are not planning to come back into the city because of commute, because of whatever reason, we've got to start thinking about and being proactive. So to me, that was shocking. Those are core plus assets, right? That's the definition of core. I mean, you're talking about stable stuff that doesn't usually come under the light of distress. So that was a big one. And then I continued to hear, especially for CLOs and, the servicers, over the last 2 weeks, that they're providing inevitable assets that are going to get foreclosed on, that they know that they are going to take them over. They're providing their borrowers 6-month extensions. So essentially what we saw during the last recession, kicking the can down the road. Of course, I'm inquisitive and curious. Why are you guys providing that extension? What are you expecting between now and 6 months from now? Is it political? Do you believe interest rates are going to go down again? And the answer I got was, as I told you guys before, It was the same one that I got from my parents when I was 4 years old, just because. And I didn't, we weren't able to get an actual understanding. And I feel like a lot of the lenders are kind of understaffed on the special assets as well. Maybe they just don't have the staffing to kind of open the floodgates. So maybe they're just preparing. But I'm seeing a lot of, especially some of the larger assets, I'm seeing a lot of extensions that are happening right now. So I feel like we're going to get into a frozen period. This goes back to the question you asked, Lonnie. I don't think that we're going to see a tidal wave of foreclosure happening. And, the kicking the can down the road worked just brilliantly the last go around, right? So I can't fault it. I thought it made no sense in 2009, 10, 11. It frustrated me, but it absolutely worked out for US Bank and Wells and all these others. I feel like there's a means to an end. There's a rhyme to the reason, but we're just waiting. And I feel like over the next 6 or so months, there's going to be kind of this elevator stuck between the floors. And that'll get me into, we could talk about it later, but some of the bid-ask spread that we're seeing between buyers and sellers right now.
Yeah, let's stick on that point for just a second, because I have about 15 questions from this, but I certainly won't go through them all. But I'll throw out a thesis, I guess, for you. In 2008, there was very little liquidity out there, and values were kind of at trough levels. So wait and see was probably a really good strategy, right? By 2010, 2011, we had seen some asset recovery, and bids were starting to stabilize at that point. So waiting had an accretive value to it. You said a little while ago, we have great liquidity. Bids are still very strong in most markets. Could a 6-month extension, 12-month extension really bite some of these guys? Could it work the other way, that, the most liquid market is now, and man, why didn't we get out when the getting was good?
So that's the problem I'm having. We're trying to convince them of that. And I say this as humble as I can with hat in hand. Over the last 2 years, we got so much valuation expectation wrong. I mean, it was just flat out wrong. We got called sandbagger. We kept the expectations so low because we couldn't catch up with the amount of appreciation that was happening. And okay, look, we told you this asset was worth $5 million. We took it out to auction and we ended up getting 7.2, which to this day, I still don't think was a justified number and logical. But now I'm trying to reverse that and trying to provide guidance and helping our sellers and clients understand that, look, this is not the same market that was 6, 7, 8, 10 months ago. Yeah, we got it wrong before, but even if you want to just go test the market, let's put it out there. Let's understand what value is. But we're trying to help you understand that right now, there's a lot of reserve. There's a lot of liquidity. And before everybody gets impacted, let's do what we can for those assets that you really do want off your books. I try to motivate them very much to consider putting them on the market and trying to get them off the books right away. But it's very difficult because we got it so wrong over the last 2 years.
Sounds like you were a hero there, Tony. You said 5.
That's what I tell them.
7.2.
Yeah. I tell them, first of all, you're welcome. The marketing obviously worked and the process worked, but and we get on the phone. It's not like, because these is my clients are relationships, right? This is not one-off stuff, right? These are people I know their families. I spend time with them physically in their different cities, and it's not just a one and done. Okay, this person paid 7.2. Let's get on Zoom. Let's sit down. You tell me, would you pay for that, right? Look at your discounted cash flows, Argus models, this and that. Would you pay this much for that asset? Do you think it actually makes sense? And that's the conversation for me that is the most important, because I want to know our mistakes. I want to know what the client is thinking. It was just so frothy over the last 2 years that I just feel like, and what I'm starting to see, there was a bidder or a buyer that just walked away from an escrow recently. They had $300,000 that was not only non-refundable, but passed through to the seller. And they walked away from the deal. And the reasoning that I was able to hear from the buyer was, we can see that this loan is going to mature next year. And we feel like the seller is going to be much more desperate next year. and we'd rather wait. And we feel the discount's going to be more than that $300,000. So it's to your earlier question. If you wait, right, I think not only are sellers doing the extension and waiting, but I feel like those sophisticated buyers are also starting to wait, right? And that's where we're seeing a spread increasing by the day.
And that's a tough audience you have. You deliver a 40% premium over what you were thinking, and guys are unhappy.
I love my abusive clients. Thanks, guys.
Well, I think you lived out the under promise, over deliver, and that over deliver just comes from maybe the market making decisions that are not logical. And to your point, I mean, I think we underestimate a little bit how much money's been put in the economy the last couple of years, and how people are still optimistic when the numbers and the data suggest they shouldn't be. And it's evidenced by, you're looking at data, you come up with a price point at $5+ million and someone pays $7 million, but they say it only takes one, it only takes one buyer to make a transaction. So it's not indicative always of what the broader market is. I guess my question is around the lenders. Are you seeing that same type of appetite to extend and pretend or kick the can at all value stratas, or are they at, maybe up to 10 million, there's that appetite, and maybe beyond that, since the risk is greater, you think they may turn a little bit quicker? Like, what does that look like? And then I guess just, anecdotally, your comments on, or your thoughts around maybe, in this instance, it seems to me it's just basic math. I mean, to Manus's point, the longer you wait, as interest rates continue to increase, like just by definition, the values are going to come down. So, that's kind of where I'm looking at this from those perspectives. Is there a value strata where you're starting to see maybe some cracks in that strategy of extend and pretend, or you think they'll turn quicker? And then just in reality, I mean, the interest rates say the values are going to come down, and that's something I think lenders are going to have a hard time defeating by extend and pretend.
Well, there are some lenders that I believe just don't have a choice. If you've got a non-recourse loan and the borrower, let's say they own 8 assets and they've chosen 3 that they want to put all their money and reserves into, they're going to walk away. And we're seeing deed and lose. We're seeing borrowers just say, okay, lender, I'm not putting more money into this thing. You just have to take it from me. And the lenders, because of the extend and pretend, they're just doing whatever they can to convince the borrower to kind of stay in place, right? Look, we're going to, take the default rate off, or whatever mechanisms they're using. I mean, that's behind the scenes. That's not what I'm involved in. But we're seeing, I think, anything that's sub 10 million or so, because we've been able to successfully sell so many assets with these auction platforms that are out there. Anything that's sub 10 million, 98% of the time, we're getting all cash buyers, right? So I don't think the loan interest rate environment really affects that. And that's where I believe a lot of the lenders and private funds that we work with, they believe that, okay, look, we can take these things out to the market, we can foreclose, and you get your arms around the leases, et cetera, and let's put it on the market ASAP. Now, when you're looking at the 30, 40, $50 million assets, that's where it's a lot more brainstorming is involved. And I feel like that's where the extend and pretend, or extend and cultivate an idea, I don't know what you want to call it, I feel like that's a lot of the strategies happening. And there are some lenders, and this is where over the last 2 weeks of doing kind of my world tour, what I came away with is that with every day that passes, the amount of uncertainty and amount of the variety of outcomes just extends, right, and increases. And people are coming in and saying, okay, look, we're extending this because we do believe interest rates are going to come back down in this 6-month period. Because if you look at global markets, the US dollar is really impacting Europe, Japan, et cetera. And we're going to have to be forced to, reduce interest rates. Now, again, this is way beyond me. I'm no economist, but that's where I'm just hearing so many different opinions. And it's just, okay, guys and gals around me, just prepare, be ready for assets that are inevitably going to come back. And hopefully we'll be able to find liquidity and buyers and demand for it. But, I have no clue as to how the world looks 6 months from now, let alone next week. Right. But I feel like their economists and their folks, are more confident that changes for the better for some of the lenders are coming early next year. I don't, but then again, I'm skewed towards the draconian. I mean, all I do is I slush around in swamp water all the time, which is the world of distress, right? I just see kind of the ugliness of greed and what it brings to folks. So I'm on the dark side.
Man, you're painting some
skewed.
Picture, right? Yeah. Sloshing around in the sludge and then getting hit by your clients when you get a 40% premium to sale, man. That sounds like, one of the greatest jobs in the world, I got to tell you.
Yeah, it's fun. I love what I do.
So, Tony, we've heard a few reports, and we talk about these on the podcast because they're interesting, these office conversions to other asset types. Is this something you see a lot of, or what's your thought about that?
The office assets that we've been managing, we've been seeing, because the existing tenants, if they do renew, they're renewing at a 1-year renewal, kind of just not making full commitments. We're seeing very little new leases happening. So we're looking at some of these very large office buildings that are, half vacant or sometimes fully vacant, whether they're in suburban markets, which I think you could be more creative with, or if you've got a downtown 30-story tower, you look at it and you say, okay, let's try to convert this to multifamily. Well, the asset may be worth, $40 million today, and the conversion cost is going to be $25 million. Okay, who's going to do that? And then they got REMIC issues with the special servicers. I don't think they are going to be able to do that stuff. So there's a lot of conversations happening around some of these assets, like, the mall conversations that we've been having over the last few years. What do you convert those to? And now office, right? I haven't seen, and I'm curious if any of the listeners have, but I haven't seen a successful conversion of an office building. I think the first one, whatever it is going to be a breath of fresh air for so many, because I think a lot of folks are going to be curious to see if the pro forma is the actual. But we're not going to know for, it's going to be 2-3 years down the line. You got to convert it. You got to then fill it up. You got to see what the turnover is. But, the floor plates of an office building are not easily convertible to a multifamily deal. So I'm curious to see what happens. But we're telling a lot of our lenders that have these fully vacant 500,000 square foot downtown office buildings, guys, it's not going to be pretty. And they're aware of it, but there are very high level conversations going on, which I really love being a part of. And we're trying to be creative, but you can only be creative for so long, right?
So you've referred to your world tour a couple of times, going around the country and meeting with lenders and so forth. So you went into a lot of offices. Were you shocked by how empty they were? Did it meet your expectations, or were you pleasantly surprised at how bustling these offices were when you were going from bank to bank, an insurance company to insurance company?
Yeah, so in the Midwest, I think there was a little bit more attendance, but I had found out that they're 3 in, 2 out, for the week. I feel like that hybrid model is, from what they're telling me, here to stay. When we were in New York, it seemed like the offices are less physical attendance there. And a lot of folks were saying, look, it's going to take me 2 hours to get into the city from New Jersey, and then 2 hours. And they just don't want to spend that 4-hour commute that they're so used to doing. So, I'm old school. I feel like the physical collaboration, the mentorship, that the generation before us kind of owes us to grow. And then when we become that mid to high level executive or person, or professional, I think we owe it to the next generation. And I think you can look, if you feel like you could train people over Zoom, great. I feel like the body language, the kind of the soldiers in the trench fending for one another and seeing and experiencing, to me, that's how I got to where I was in 2008, 9, 10, 11. I got to learn about the financial institutions, the lenders, and kind of see what happens behind the scenes. I feel like in order to be a successful team, you need to physically be with one another, and maybe 3 days is enough for folks. But I've heard rumblings that there are going to be institutions that require folks to come back. And with the job market issues right now, some of these folks are saying, look, we want to stay home, but we want to get paid 20% more. Well, it opens it up to, if you're based in San Diego, California, well, what keeps me from hiring somebody out of Milwaukee, which is going to be substantially less? If you want to stay home, then now you've opened up my options as an owner and entrepreneur for folks that I can hire all across the country to save costs.
That must be some pitch to your young guys. Come on back and join me in the 4-foot swamp. It's dark. It's dank. Right? It's messy.
Yeah, look,
but
roll up
it's
your
fun.
sleeves.
Roll up your sleeves and join me in the swamp.
Right.
Wow.
Yeah, not in your cozy, warm pajamas, right? We want to put on our boots.
Well, you're in the swamp, but you leave us with, where's the opportunity right now?
Yeah. So for us, the opportunity is to help our lender and institutional clients strategize, right? I feel like the conversations and plans that need to be put in place now and in the future are going to be much more scrutinized and detailed. And, over the last 2, 3, 4 years, we would provide valuations that honestly, I knew our lenders were just looking at the file and they were putting it in a folder and they were just moving on. Now they're actually reading the stuff that we provide to them. And we're constantly getting on a phone call with the asset managers and explaining our mentality and what we're seeing and what we think we're going to see. So there's the opportunity from a service provider. If you really know what you're doing and you're an expert in your market or your asset type or the service that you provide, this is your time to shine, because those lenders and those clients are really going to need help. So to me, that's the opportunity is, being that trusted advisor, really taking a risk or a leap of faith and trying to convince folks that, look, we're here to help you. And, it's important for us to have those tough conversations. I think from the investor standpoint, like the office conversion, like the vacant retail boxes that we're redeveloping into multifamily or self-storage, I think anyone that's creative and able to find, opportunities that way, they're going to really do well. I feel like from a financial institution standpoint, if you're the Wells Fargos and the, even the regional small credit unions and the banks that I feel extended themselves in order to compete with the life companies and the larger banks, they're going to have quite a bit of trouble. And I don't think they're going to have the staff to take back real estate. So the opportunity for investors is to contact these banks and try to purchase the notes. You need to understand bankruptcy, you need to understand foreclosure and all that. But I think that's where the opportunity is going to be in the next 6 to 12 months, because a lot of the banks really don't want to take assets back for whatever myriad of liability or risk, whether it's environmental or whatever it is, right? So I think that's going to be an opportunity. And what we do with you guys, we monitor Trepp on a daily. We look to see what the asset managers are providing in terms of that asset. And we're constantly reaching out to all the special servicers that we work with. What can we help you with? From boots on the ground to valuation. Can we go and take photos? Your borrower is telling you that it's 90% occupied, or sometimes the borrower says, hey, it's only 40% occupied. Well, we'll drive by and we'll take photos of the property and say, oh no, this thing is much more active than the borrower is leading off to. So it's just do what you do for your clients, be there for them, help them understand that there could be some hurt in the future. But, I think being prepared is going to help folks be successful.
Wise advice. So Tony, how can people reach you if they have any questions about some of the stuff that you've talked about today?
Yeah, email is fine. It's tony.yousif@svn.com. That's YOUS as in Sam, IF as in Frank. So, feel free to email me. You can find my contact information, or you could look me up on LinkedIn. But yeah, appreciate it. And I do want to, there's a couple of shout outs, Daniel M. and Watson for turning me on to the TreppWire. I've been listening a lot furiously, kind of getting prepared for this one. So you guys are really good at what you do.
Thank you for that. And thank you, Dan M. We know where you are.
And thank you, Watson.
And with that, we'll close this special podcast. Thank you to our guest, Tony Yousif. Thanks to our producer, Haley Keene. Join us later this week as we look at what's happened during the week and how it may be impacting you. If you have a question, send your email to podcast@trepp.com or look for more topics on either Twitter or LinkedIn. Subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.